Most of us assume that the ultra-wealthy built their fortunes using secretive offshore accounts or complex insider trading strategies. But if you were to open the vault of a typical billionaire, you wouldn't find mountains of physical gold. Billionaires operate on a distinct psychological framework that treats capital as a tool for allocation rather than a resource to be hoarded. Most people default to the traditional saver approach. We're taught that keeping cash in a standard, low-yield bank account is the safest possible route. Over time, inflation erodes the value of that cash. When the cost of living rises while your balance stays flat, your purchasing power quietly evaporates. To counter this, we have to look at the habits of the traditional saver and contrast them with the logic of a capital allocator. This guide is designed for frustrated earners who need to bridge the gap to financial freedom by focusing on the underlying architecture of wealth. We're taking 6 abstract principles used by the world's wealthiest people and translating them into a grounded, daily checklist you can use to upgrade your financial habits. Shifting from a fearful saver to a strategic allocator provides the necessary framework to maintain purchasing power and build wealth across decades. This chart maps these wealth-building rules by how hard they are to execute versus their long-term payoff. We start down here in Phase 1, plugging the leaks. Entrepreneur Mark Cuban stressed cash to kill high-interest debt, like credit cards. This chart shows exactly why. If you're paying 20% interest on a balance, paying that off immediately stops that drain. You are securing a 20% tax-free return on your money right now. There's a trade-off, though. Throwing all your extra cash at debt leaves you feeling cash poor. It requires strict discipline and delays the start of your actual investment portfolio. Next is Warren Buffett's foundational rule. The best investment is in yourself. Instead of spending free time relaxing, you use it to acquire high-leverage skills. Expanding your knowledge and communication skills increases your baseline earning power. A skill is an asset that cannot crash like a stock, and inflation cannot take it away from you. The downside here is the mental exhaustion. Learning demands a massive time commitment, and it offers zero immediate passive income or a certain timeline for when you see a raise. You cannot effectively put money into the broader market until you've stopped paying high-interest penalties and maximized your own ability to generate cash. Once your leaks are plugged, we move up to Phase 2 on the quadrant, external market exposure. This is where the traditional saver hesitates. Many of us are wired to view cash in a bank as safe, while treating all forms of market investing as gambling. Elon Musk advocates for taking calculated risks. This means deliberately putting capital into index funds or businesses where the potential upside outweighs the downside. By stepping out of your comfort zone, you expose your money to compound market growth. This exposure is required to outpace inflation over the long run. The cost of this growth is short-term volatility. You have to accept the reality that you will see your portfolio's value drop during market corrections, and you have to stomach it without panic selling. To survive that volatility, allocators turn to Ray Dalio's rule of diversification. Spreading your capital across different types of assets protects you from catastrophic ruin if one specific sector collapses. However, diversification limits your extreme upside. You are choosing consistent, reliable returns instead of chasing a high-risk stock spike. Replacing the paralyzing fear of volatility with calculated, diversified risk is what separates the victims of inflation from the people who benefit from economic growth. That brings us to the final phase of the allocator's playbook, applying the single most reliable lever available, which is time. Jeff Bezos points out that wealth building rarely happens overnight. He argues for abandoning short-term expectations and adopting a 10 to 20-year horizon for major financial decisions. This horizon allows compounding to function. You automate small, consistent investments, and the returns from those investments start generating returns of their own. This graph illustrates the process. For years, the line is relatively flat until hitting an exponential growth spike, where your interest makes more money than your out-of-pocket contributions. Right here is the critical inflection point, where growth shifts from linear savings to exponential wealth. But the psychological toll is heavy. Leading up to that point, your progress is nearly invisible, which makes it incredibly difficult to stay the course. To reach that exponential curve, you have to ignore the social media hype. You must resist chasing quick profits and allow the process to work. The evidence shows that extreme patience and the consistent application of compounding are the primary drivers of billionaire wealth, far outweighing the impact of high-risk stock picks. Execution begins by applying these 6 rules directly to your current net worth and income. We can use this mapping system to determine exactly which principle you need to prioritize first, based on your current assets and liabilities. If you are on the debt-heavy path with high-interest credit card balances, prioritize Mark Cuban's rule. You must clear that debt before attempting any other investing. If your debt is cleared but income is low, you're on the time-rich but cash-poor path. Your priority is Warren Buffett's rule. Build a new skill to increase your market value. If you are a traditional saver sitting on a stagnant cash nest egg, you need to deploy Dalio and Musk's rules. It is time to accept calculated risk and expose that capital to the market. To make this operational, run your decisions through a daily checklist with 3 items: the skill check, the logic check, and the allocation check. First, the skill check. Ask yourself if you deliberately spent 30 minutes today improving a capability that makes your time more valuable. Next, the logic and allocation checks. Verify that your recent financial choices prioritize a 10-year horizon and ensure that every single dollar you earn is assigned a specific job. These rules are straightforward, but not easy. Building lasting wealth requires trading the short-term comfort of hoarding cash for the long-term discipline of allocating capital.